After the dollar peter out and run out of steam, I think it's going to be probably in the fall. It may be extended towards the end of the year. Looking at the lockdown situation and a bit of geopolitics there, but whenever the dollar peak, the next run up for silver is going to be the granddaddy of them all.
Joining us back on Wall Street Silver is John Lee. He has over 25 years in the silver market and also the chairman of Silver Elephant. How are you doing today, John?
Doing fine. Thank you, Ivan, for the invitation to be back on your show.
Awesome. Well, it's a pleasure to have you. First question right off the bat. Give it to us straight on Wall Street Silver. Are you pissed off silver isn't at $30 yet?
Yeah, the question is expected. Ivan, I look at the technical trends and draw some parallel to what's happened in 2009 financial crisis. This is why it's not a similar, except it's actually bigger in magnitude in global scale with this pandemic crisis. The dollar, gold and silver trades an antithesis to the dollar. And in last crisis, 2009, dollar dived 10% from 87 to 77, around 10 to 15%. Mm-hmm. And this time, and then a year later, about 1.5 years after the 2009 financial crisis, in early 2009, 2010, in early 2010, he staged a complete rebound for the dollar back to pre-crisis level. So fast rolling back to where we are, the dollar started at about 100 before the crisis, went down as low as 90, 89. Mm-hmm. And it's been about 1 year and 3 months since the height of the crisis. And that it's not unusual and it's not unexpected to see a rebound of the dollar. And I think that's exactly what we're looking at. I think overall silver is at 2025. I'm not pissed. I think it's part of stocks go up and down. However, I was actually quite encouraged while preparing for this interview. I mean, in the last time around, silver went from 17 to 50. That's when the dollar index was at about 80. Yeah. And this time the dollar is, at 100, but yet gold is at 1800 and silver is at 25 on the cusp of a major breakout of $30. So, just shows you that globally there is lost confidence of the dollar. It's what I call the controlled demolition. Mm-hmm. But the silver and gold were able to stage a good bull market, even while dollar is going this secular sort of counter-cyclical rebound in the last 10 years. So I'm not discouraged, and we're going through summer. There's always the proverbial saying, selling May and walk away. And the silver correction might have the dollar rebound. The silver correction could have another six weeks to go, and that's why I see the market.
Yeah. So is this a time that you'd be cautious? Then you said sell in May and go away. The proverbial saying they have. Is this a time you'd be cautious in the silver market, or is this a time to buy the dip and go all in? I mean, it seems like. Here we are below 25. What do you think?
Well, Jim, we all still are dealing with probabilities, and there's always exception to the rule. However, as a trader, it depends also on the standard CFA chart financial analyst answer, depending on your time horizon, your risk tolerance. The silver is below 200-day average. Mm-hmm. So is gold, and contrary, the dollar is above 200-day average. So I think it's a rule of thumb. Personally for me, during my trading days, the way not to lose a shirt and not to sort of ride all the way back to where you started and worse is to avoid averaging in positions when it's below 200-day. Mm-hmm. You might be selling below when the technical breakdown, but you certainly will not be adding. For the prudent investors, you want to sort of maybe double up or averaging in after silver has rebounded back above 200-day. Right now, I think it's at around 25.80. Jen, I was on your show about 4 months ago, and like around March or April, and I said, I don't have a call in silver, and it's going to oscillate around 24 and a half and 27 and a half. So that's all we have. Yeah. Just drawing a bit of going back to the 2009 financial crisis, during that dollar rebound post-crisis, it was a 6-month rebound. And now the dollar rebound is about 2 months in, 3 months in. So the silver could spike down. I mean, silver has great fundamentals. There's no question about the physical shortage, and it's well documented. But however, in the short term, the commercial trades and futures market dominate the price trends. And you could see it spike down to 22, 23, below 24 briefly for a couple of weeks. You just want to make sure, Jim, if you were to averaging in right now, you have the staying power and that you are mentally, psychologically capable, and not to be, my wife said, I know John's mood just looking at what the silver closed the day before. So you just want to make sure that you balance your sort of pros and cons when you're averaging in, and be mentally prepared if silver were to suddenly go, dip to $22, $24 level, and that you have that staying power. And that will coincide to the dollar at around 95. And that would be a bit of a major resistance. And I don't think dollar this time is as strong as it was 2009 when it scaled all the way back to pre-crisis level. I think this time it's going to be around 95, 96, if at that, which is around a tracement of 50% of the fall from 2020.
Yeah, well, you just mentioned the global supply issue, and I just shared one of my favorite graphs from SRS Rocco.
Yes.
This is global mine supply. And, we just talked to Keith Neumeyer about a week or two ago. And, he said this 2020 number at 784, it's actually, he thinks that's a little high. He thought it was closer to 750 was the real number last year. But he thinks we are going to have a rebound in 2021 because, there were a lot of virus interruptions last year. And so he wouldn't be surprised if he saw a higher number for 2021. But, the key to keep in mind is 2015, 2016 was the peak in production. I think everyone agrees on that. What are you thinking for this year, next year in global supply? Do we resume this downtrend, or do you see any bounce back?
Well, Jim, I follow not only silver but other metals, and gold and industrial metals and copper, nickel, or even in oil, which I spend a lot of time studying in the energy sector as well, Jim. The 780 million ounces you look at that number, probably around 500 million ounces are industrial demand. So these are what I call the price takers. When the prices go high, they try to dance around and defer their capital expenditure, defer their purchases. They try to find substitutes. They try to invent technology to reduce their demand. So I don't read these supply and demand pictures so much. They're never a good indicator. I think if it is so easy, then everybody would make money, right? Yeah. Inventory production levels, supply and demand is never a good indicator looking forward. So of this number, you're looking at probably 500 million ounces, just price taker, Jim and Ivan. They look at what's being printed during the day, and it's always that speculative demand that drive that frenzy. 2011, that was Eric Sprott with some Asian investors. Started to corner silver in 1980. It was the Hunt brothers, and also if you look at cobalt, for example, again, it's some speculator from Pala, from the Swiss. They cornered the cobalt market back in 2018. Cobalt went 4 times from $10 to $40 a pound. The same is going to be for silver. So I would not actually pay attention on the industrial demand from jewelry and from all the shops. What you want to focus on is, what is investment sentiment? How is the unidirectional generalist funds view on commodities and on gold and on silver, and also a lot of times gold is simply a laggard silver is simply a laggard to the gold market. Look at 2005. It took about 3 years for silver to take off before gold took off in 2011. A lot of the central bank allocation in gold and major funds in allocation in gold sometimes would set the tone for the silver market to follow. So I would almost focus exclusively, and also the ETF movement in silver is also a much better, I think, indicator to tell what's what's to come in the future, and not so much about the overall supply and demand of silver.
Yeah, I like what you just said was the price takers, the 500 million ounces per year from industrial demand. They really don't care what the price is. They got to have it no matter what for their Apple iPhones or their
same with Jim, same with Ivan, same with uranium. It's exact same story. You know, the crazy action uranium in 2006 went to 100 from 10. It's not because all of a sudden uranium plants want to buy nuclear plants. It's because the speculators come in to completely throw the equation out of order and cause that frenzy. And it's not going to be any different for silver. After the dollar peter out and run out of steam, I think it's going to be probably in the fall. It may be extended towards the end of the year. Looking at the lockdown situation and a bit of geopolitics there, but whenever the dollar peak, the next run up for silver is going to be the granddaddy of them all.
That leads into my next question. Let me pull up my dollar chart here. The 10-year is tanking here, as you can see, John. It's just fallen off a cliff, and you would think that in that scenario that the dollar would be less attractive, right? Because the yields are declining. Dollar is not as good of an investment for people. But here at the same time, we're seeing, dollars sort of breaking out at the same time. That's sort of counterintuitive. What are you seeing there?
Yes, Jim, if you look at the 5-year chart, if you click on the 5-year chart, you will see the congestion, the dollar congestion that I was referencing earlier at around 96. You can see the 96 level, there's a very big congestion in that level, which the highest target for the dollar before the end of the year, maybe by the end of next month in August, before the metals bull market resume. Now, the treasury market is also heavily managed, if not more so than the metals, because the treasury market is the largest market after the US dollar currency market. I would not read too much into the current treasury yields. I mean, honestly, what's the difference between 1% and 1.4%? I mean, you minuscule of proportion. And I think if anything, Jane, if you look at 2017, 2018, there was a breakout of the 30-year and the 10-year. That was a major breakout in yields. However, for some mysterious reason, the genie was put in the bottle. Keep in mind that yield trades opposite from the price of the note, 10-year notes. And the Fed has a limited amount of power to support that 10-year yields, to support the treasury note, to suppress the yields. To the point, unless you have hyper rampant inflation of oil over 100, which is a possibility, they're going to continue that gain. Now, the question is, to your question, why is dollar rebounding and yields are so low? I think there are two reasons for it. First is because the dollar has gone down more than 10%. That's a pretty big deal for the reserve currency since the crisis. And secondly, is actually the world is more globalized than ever. Like despite all the groaning globally, the dollar payment system, the US GDP is still around 25% of the global GDP. There's concerted effort, and I think a lot of the G7s are willing to play ball. And the other currencies, and dollar is a basket of other currencies. Australia is going lockdown, doesn't make any sense because there's only 100 cases. And UK, is providing, UK cases are surging, and it's almost like inevitable that there's going to be another lockdown in the fall. And the Eurozone growth is always being anemic, and Asia is having a second wave. So you look at sort of I think the two factors. One is the rebound of the dollar. So some people maybe gone overstretched on the dollar carry trade, and now they have to close their position, and that's sort of exacerbated the rebound. And secondly is that there's just no better alternative, which again spells actually quite well towards what we said at the beginning, Jim and Ivan, that is last time gold was 2000, in 2011, dollar was 85. And now gold is same as it was 2011, but yet dollar is 10% stronger than it was before, last time around. So there's definitely spill effect of the fiat out of the fiat into hard assets. Sometimes it takes a little longer to play out. However, I think the macro thing to keep in mind is the yield is going to stay very, very low because the world depends on low yield, and we're beyond the point of no return on on the debt load and monetization. Nobody cares about deficits. It's 3.5 trillion deficits spending coming down. So there's no regard for everybody's plundering everybody. So the fundamental is very strong. And now we're just in this technical correction where the dollar is bouncing and the metals are correcting.
With the treasury yield falling like this and inflation going up to above 5% in the United States, negative rates, negative real rates are in play here, probably worse than at any point we've seen in recent memory, going back to probably 2011.
Yes.
Why, I would think gold would be at an all-time high right now based on where the numbers are. Is this just that we don't have any? I mean, what do you think the cause is why we're not? Why is the market ignoring such negative real rates right now?
The market's not ignoring. There's different forces in play, and who's got a bigger, who's more muscular, who's got better, more firepower. And as I mentioned, the yields trade converse to the note. Yeah. When you have a big firepower, the big granddaddy of them all, the Fed, that's supporting. And this is not just the U.S. Fed. BOJ is 70% of the buyer for the Bank of Japan bonds. Not only bonds, but 70% of the Japanese equity ETFs is Bank of Japan that's buying. And you look at the Fed, it has unlimited firepower in all measures. And so, and we mentioned that before, Jim and Ivan, it doesn't make any sense at all to be lending somebody 10-year at 1.5. No sane person would ever do that. I'm sure if we would have abolished the Fed like that would ever happen, that the rate would instantaneously jump to its more natural equilibrium based on historical context. You'll be looking at around 5 to 10% for the well-credited. For the guys that are subprime, we'll be looking at 10 to 15%. So I just said the market's heavily managed. We are talking between 1.5%, 1.5%. And I just don't think that's actually a read into where the metals are headed. However, Jim, if we were to pull up the silver chart from the 15-year silver chart from 2009 to today, we are actually bearing a lot of resemblance to the price action in 2009 in terms of technical analysis. I mean, if you look at silver, it's been meandering, it's been consolidating at around this 24 to 30, really at around $22 to $28 range for almost a year. It's very, very similar to silver post correction in 2009, where silver spent about a year at around 15 to 17 and a half. You can see that from 2009, and then all of a sudden it took out that from 2010 to 2011. All of a sudden, the light bulb came on, and then boom, it triples. So we're at that exact same juncture. If you see silver today, we're at around 22 and to 27. So that is exact same sort of play we're at. And now you say, why does a catalyst for silver to do exactly what's now today to what silver did in 2011? And I'm going back to what I was saying again, is the magic of the dollar. Soon as the dollar run out of steam, and that's going to provide that the tailwind for silver to break out of 28. I would say 27 and a half or 28, whatever that is.
Yeah.
And I think there's a good opportunity depending on all the different configuration of the market in the dollar, in the equity, in oil, in everything. So I'm happy to come on your show at around September. I think September will be an interesting opportunity because it's traditionally strong season for metals. However, if you have a heavy equity correction because of a lockdown and you have a spike in the gold price, which is not actually friendly to silver, then you might have to defer the silver run until maybe in the springtime of 2022.
The markets are so manipulated. You're right. The granddaddy, the Fed, is just putting its thumb on the scale so much that I think it's just destroyed all sorts of price discovery, all sorts of. So many people are just confused that the usual signals don't mean anything anymore because of the manipulation. And I don't know, do you find some of the lessons you've learned over the years just are not valid anymore? Based on
not so much not valid. I mean, the way they're still market participants. It's just they have a different motive sometimes than profit seeking. And keep in mind, Jen, if they go overboard and show too much of a red, the bankers still get spanked. So they still try to find a way to manage the market, but still make some money in the interim. That's why, Jim, the technical indicators are so much more the importance. And a lot of the message and a lot of the factors that are factored into the technical trends. So I think my analogy, as I shared with you guys before, was the dam analogy, right? The water is going to continue to build because the liquidity is not going away. You have 10 times more millionaires than it was 10 years ago. So that the liquidity is there. The interest rates are low, going to stay low. And eventually, it's a very small market, a billion ounce. I mean, gentlemen, a billion ounce at 20, it's a $20 billion market. Yeah. It's minuscule in the overall scheme. So somebody can let a match and it will go. So that's why I don't encourage people to trade in out of your positions all at once, completely, because you're going to miss the boat. But rather, I think for the guys that had a long-term horizon, sort of like me, put silver ounces away and forget about it. I think now is a good time to average in because your downside is around 10%, and you have a lot of upside to speak of.
Gotcha. Hey, let me ask you one other question. Are there any other, we talk about silver and gold here a lot, but are there any other commodities that you find interesting that our audience should pay attention to right now?
There are two metals that really interest me. One is silver. The other one is nickel. And nickel went because nickel went from $5 to $20. It has a lot of torque, and there's very few nickel mines out there, and it's a limited supply. Not like copper, you can stumble somewhere and make a big giant copper discovery. And nickel had a new sort of way of life. It discovered a second life in the use in batteries. Mm-hmm. And Jim and Ivan, the new Tesla, and now you have the new Model S Plaid that can go 0 to 60 in 1.9 seconds with a range of 350 miles. And the market has spoken. Nickel is the de facto standards in these high performance. So I see a big secular trend for nickel coming up. And good enough, I'm also very active in Twitter. You can search me, John Lee Silver Elephant, that the trend for nickel, the price chart for nickel looks incredible. And I've been telling people to stay away from crypto. The chart looks very, very sick. And then rotate into nickel is a full-fledged bull market that just broken out of its 9-year high. Now, right now at $9 a pound. Start of the year is around $5. And there's also good sort of indicator in ratio. Usually nickel trades around 4 times the copper. So, and that's a historical sort of that's a historical ratio. And nickel's been undergoing correction because of the laterite out of Indonesia, but it has a lot of environmental concerns. They never really lived up to expectation. Mm-hmm. And so if you were to use that ratio of $4 times $4 copper, you're looking at $16 nickel. And gentlemen, I'm just on the show and said, that is my target by the end of next year. It's a stealth bull market that very few have noticed. You have a lot of deniers that are still out there. And I think it's a great entry point from technical and from fundamental points of view, and provides a bit of diversion to the guy that's the silver bugs and looking for a bit of diversion from the summer doldrums. And interestingly enough, as Jim says, Ivan, full disclaimer, I'm the largest shareholder of Silver Elephant. We have a good silver asset, but we just picked up a nickel asset earlier this year when nickel was around $2 lower than we are right now. And nice. We really had a lot of pushback from our shareholders. We buy the bullet. Keep in mind, we could be sitting $10 million in cash, sitting pretty, enjoying our Christmas, drill a couple of holes, and have a good time. But we choose to deploy that $10 million to buy this nickel asset, and because we see really a short-term pain and for long-term payback. So I'm very, very bullish nickel, and the technical trends is confirmed that breakout.
Well, we will be sure to follow up with you next time in a few months on your call on the nickel market also. Mr. John Lee, thank you very much for giving us your views on the market, the silver market, and now the nickel market. And we'll talk to you again next time.
Thank you, Jim. Thank you, Ivan.
Take care, everyone.